Good morning, everyone, and welcome to the third webinar of the Seamless East Africa webinar series. Today, we have a 60-minute panel discussion entitled Responsible Microfinancing and Lending for SMEs and Consumers During the Coronavirus Pandemic. We're lucky to be joined by 4 industry experts on the panel today who've kindly agreed to share their insights as we discuss digital lending innovations. Joining us as panelists, we have Shakila Kerre, who is the Manager for Credit Innovations at FSD Africa, Ivan Mbowa, who is the Regional General Manager for Tala, Mamadou, who is the Vice President for Social Impact for Central Eastern Europe and Middle Eastern Africa at Visa, and moderating the session for us, we have Hennessy-Barrett, who is the CEO at 4G Capital. In a moment, I'd like to hand over to Wayne so that we can get started. Please can I ask all panelists to turn on their webcams and microphones. And whilst everyone's doing that, please can I remind all webinar attendees that you can ask questions throughout the panel session and our panelists will do their best to answer them. So without further ado, Wayne, over to you. If you guys could all turn on your cameras and microphones, we're good to get started. Sorry, we're just having a little delay there. Wayne, are you there? Good to go? Oh, I think Wayne might just be having some connectivity issues there, as it looks like it just popped up. So just when Wayne's getting everything fixed, I don't know, maybe we can start with you guys introducing yourself. Oh, here's Wayne. I'll hand it over.
Julia, thank you very much, and apologies for the connectivity at my end. A great pleasure to be part of this panel. We are at a time of great challenge around the world. The most vulnerable are now more vulnerable as the measures taken to protect people against a very aggressive virus are taken, and to prevent that transmission sees a lot of inhibition and a lot of restriction of economic activity. That hits the people who are living hand to mouth the hardest. And so we have a tremendous panel here together. Julie, you'll have to forgive me. I've just come back on. Have people had the opportunity to introduce themselves yet, or are we moving to that phase now?
No one's introduced themselves yet, so go ahead.
Great. So I'm your host for this morning, Wayne Hennessy-Barrett. I'm the founder, CEO of 4G Capital. We're a Fintech SME credit provider operating in Kenya and Uganda. And we provide working capital microloans together with enterprise training for these very small micro enterprises to be able to grow their revenues and provide a better livelihood. Without further ado, I'd like to introduce my co-panelists, starting with Shakila from FSD Africa. Shakila, over to you.
Thanks, Wayne. Good morning, everyone. My name is Shakila Kerre. As mentioned by Julia, I'm the Manager for Credit Innovations at FSD Africa. So FSD Africa is a financial sector development agency seeking to strengthen and create resilience within Africa's financial system.
That's fantastic. Thank you so much. Ivan, over to you.
Oh, I think you've just got yourself on mute there, Ivan.
Thank you, Juliet. I have been on mute this whole time. So my name is Ivan Mbowa. I'm the Regional General Manager at Tala. Tala is a mobile technology and data science company that focuses on the provision of credit to underserved customers. Has been in operations over 6 years, and in that time frame, having begun in Kenya, has been able to extend credit to well over 7 million people across the world, with loans dispersed over $1 billion, and really pioneered the Android smartphone credit model in East Africa and throughout much of the developing world.
Fantastic. Thank you, Ivan. A pleasure to have you aboard. And Mamadou.
Oh, thank you. Good morning, everyone. Mamadou Biteye, Vice President for Social Impact for the CEMEA region, which includes Central Eastern Europe, Middle East, and Africa for Visa. Visa is the world leading payment technology company that connects over 61 million merchants to in 200 plus countries and territories to 3.4 billion payment accounts through 5,500 financial institutions. Visa as the oldest fintech is really ambitioning to connect and enable individuals, businesses, and economies actually through the most reliable and secure network for them to strive.
That's fantastic. Well, we all know Visa, we all know the scale and the scope of the payment services that you provide. And so maybe it would be helpful if we sort of start off with a question for all our panelists now. How do you see us getting out of this? How do you see us bringing the economies in our emerging markets through these challenges? And what kind of time frame are you looking at? Mamadou, would you like to share your thoughts?
Yes, first of all, I think that this is a protracted crisis, we are experiencing it, and there is a lot of uncertainty in it. This is why I think that we need to have at least 2 moments around this. One is actually how do we as a global community withstand the current crisis? What do we need? What things do we need to change in how we conduct business? What facilitation governments and other stakeholders have to provide to enable businesses and individuals and economies to withstand the crisis? Then I see a second phase which is more of a recovery and rebounding from the crisis. And all of that, and the way how we actually rebound and thrive from on the other side of the crisis will depend really on everything we put in place today so that we are not falling back too much so that we can withstand the crisis. So for that, Visa is doing a number of things. One is really expanding the use of payment for business and consumers touchless, including raising the limits so that they can do it without PIN, without signature. All of this contributes to reducing contamination. It is also making it easier for business to get online. So we're waiving currently monthly fees and up to June 1st for new clients that are using CyberSource to start a business online. So how do we facilitate that? We're helping small businesses also drive sales and encourage people to shop locally. On June 1st, we will be launching a new campaign that is dubbed Where You Shop Matters, and that helps people identify the merchants, the businesses in their community where they can shop. That strengthens the local economy. And we also use the power of our network and the data we have to provide data insights into economic performance. And that we are providing to over 20 government agencies across the world. And we provide also information to consumers on businesses that are opened. Because one of the key things we've seen in the US was that when businesses close, information about who is open, where to get information, where to shop was really a challenge. So really making sure that every business that is open, if it was closed, actually and we are bringing this also to Africa, particularly launching in South Africa around that. And finally, we also provide increased access to learning, particularly to learning platform and increasing digital around that. But of course, I will talk maybe later about what we do from a philanthropic perspective, but also what we do from a policy perspective, advising governments and central banks on what policies need to be taken to actually reduce businesses falling, but also enabling to recover and rebound.
That's fantastic. That's a great overview, Mamadou. Thank you. Ivan, tell me, how do you see this playing out? You're on the ground.
Sure. I think very similar to Mamadou, I also see a two-phased approach. So I think on the first approach is really diagnostic. Really just increasing the capacity of many of the countries to do adequate testing, so you can really get a sense for what is the extent of this surge in terms of the viral infections, and also more importantly, what's the trend, right? And I think also tied to that, I think is also, of course, supporting institutions, be those hospitals and others involved in the relief efforts. But the second phase actually is really now actually about business confidence and the resumption and trying to sort of resume within the new normal. To some extent, I think there's been a lot of criticism that you know, the cure that many governments, especially here in this part of the world, are taking is worse than the actual disease that they're trying to solve, right? When we think about the effects of social distancing, et cetera, on economies. So I think that it's also critical that once we have adequate testing in place, that we need to begin moving towards a resumption of the new normal economic activities. And that's really also tied to mobility, improving and increasing the sense of general confidence so that consumers can get spending again, and you can have that trickle-down effect flowing throughout the entire economy. You know, and I think without those two in place, i.e. adequate sense of sort of testing levels, and then also likewise a resumption of confidence and mobility, I think will be very hard for businesses to resume. And we as Tala have been involved, I think, on supporting both sides of those two phases. On the first part, we established a community rebuild fund, $6 million, committed to support businesses who are directly tied to relief efforts around sanitation, food, transport, providing them with 6-month interest-free loans. And then also in the second part, when it comes to business confidence, we are actually piloting both financial coaching, which is essentially to help our customers navigate how do you actually still spend with limited income. Some of our customers have been laid off, they are on furloughs, salary cuts, et cetera, so giving our customers a sense of how to navigate through this crisis. We are also focused on actually piloting a micro health insurance, which I know Wayne, your company is likewise working with the same provider, which would be a critical part, which is just making sure that people that do have cover in the event that they are hospitalized, they're able to sort of reduce the negative impact in their pocket and hopefully be able to bounce back. But yeah, so just to answer your question, I think really there's two things. One is let's get our diagnostic levels up and running, and let's get business confidence up to a level where we can resume our new normal.
Great stuff. Shakila, how do you see this playing out, and what do you think are the biggest concerns and levers that can be pulled by policymakers and by businesses at all levels?
I'll speak to the broader financial sector, and specifically with respect to just the credit market and the credit crunch that is there currently, and that will probably be there into the foreseeable future. So just like Mamadou and Ivan has said, we need to look at this both in the short term and in the medium to longer term. So what is happening currently is that SMEs, which are the backbone of most of African economies, are actually either out of business, have reduced economic activity, and the implication of this is that they're not able to pay their salaries, they're not able to sort of sustain their businesses, and some are lucky, so some businesses actually have an upside within this COVID pandemic. These are mainly the health SMEs, but even then they don't have access to working capital to sort of increase their production, increase their level of businesses. So what we as FSD Africa are trying to do is to sort of see how we can provide short-term relief and medium to longer-term relief. And we're looking at financial service providers. We're trying to see how we can structure sort of COVID relief debt funds. And why COVID relief debt funds? Because this is very risky capital that these financial service providers are looking at, that their normal or typical investors would not be willing to facilitate. So we're trying to see how we can come in to provide that capital to at least enable financial service providers. This could be banks, this could be MFIs, other alternative credit providers, to at least sustain the small businesses within this short term when they're actually not doing business. So this is enabling them to lend, to provide moratorium, so actually just facilitate working capital to help businesses that are completely not working to sustain the operation, so at least pay salaries. But then in the longer term, we will also try to see how we can enable access to credit to SMEs as they try to sort of resume normal operation. And of course, with this pandemic, then it's two-pronged. So there's a supply side and there's also reduced demand. So definitely it's going to be into the next 12 to 24 months before things get back to normal. And it's essential that there are funds available in the market to financial service providers to facilitate lending to businesses when their revenue streams are quite limited, or some will naturally not even have any revenue flowing in, I think, as I said, within the next 12 months. So that's what we're looking to do.
That's tremendous. That's very, very useful. I think that service could not be needed more at the moment, particularly as the lenders who are trying to help the businesses themselves are struggling as well. We've got a couple of questions coming in from our attendee group, and I'll just take it from the top before we go back into the question sets, which I think speak to the discussion in greater depth and allow you to unpack and talk more about your individual strategies and how you're addressing the COVID crisis. Question here from Kevin Genga, a regulatory question relating to the recent CEK directive on defaulting of blacklisters by digital lenders. And is this turning into a reduced marketplace for other lenders in the digital markets? I think this is quite a hot topic this year. Certainly the Central Bank of Kenya has been making a number of quite important signals on the customer protection front, and use of CRBs in an automated manner. It's something that is contentious across a number of digital businesses and platforms. Shakila, what's your perspective on use of the CRB and indeed what the regulator can do at this time to try to help move things along?
Okay, so I think just the immediate impact, and Ivan can correct me if I'm wrong. So most digital credit providers, at least in the Kenyan market, were heavily relying on the CRBs to at least try to manage their level of non-performing loans. So when that has been taken away, I think we've seen a reduction of some lenders are completely not issuing new loans to low-income earners. And it's understandable. And I said, this is linked to my earlier point on source of capital. So in the absence of risk mitigation factors, so what other options do digital credit providers have? And again, the solution will be two-pronged. So not only from the government side and also the digital credit providers. And it will be just how innovative are they looking at their data? So the argument has been that they've, over time, over different credit cycles, they actually have a lot of credit data, so they can improve the algorithms and not rely so heavily on blacklisting people on the CRBs just to ensure that they have collections. So it's how innovative, how are they looking at their current business models and the algorithms to make sure that they can actually, and are still lending to people who are good for their credit. And then for government, I think needs to look at the whole CRB angle again holistically. So traditionally, CRBs have never been effective within the credit market. So either the data within is not holistic, so either they have just data from banks or few regulated MFIs and locking out a huge chunk of credit providers. So it's for government to sit with credit suppliers to see how CRBs can be effective for both them and the consumers. So to derive mechanisms and guidelines to ensure that all credit providers actually are mandated to report to CRBs, and that CRBs also adjust their reporting mandates or frameworks for digital credit providers, because the pushback often is that CRBs collect data in a way that's best suited to banks, so to traditional lending institutions. But in a market where we have a lot of alternative credit providers who are mainly digital credit providers, so how then do CRBs adjust to this? How do they understand the digital credit landscape to ensure that they collect appropriate data? Then the credit scoring ultimately from a client perspective is reasonable and is accurate to enable lending from different sides.
That's really helpful. That's a great overview of some of the challenges. Ivan, how's this affected you?
Yeah, so, it's really interesting. I would say that it's quite unfortunate that the central bank went ahead to remove the ability of third parties like non-banks to contribute information. But I think we have to tie a very important difference between correlation and causation. So what you typically see is that many of the digital lenders were already beginning to sort of pull back the amount of credit that we're putting into the market, and that's for good reason. We're seeing a lot of our customers struggle to repay. So I know that a number of fintechs had already begun sort of significantly reducing lending. But now that you sort of combine, let's say, the COVID effect on the portfolio with the removal of perhaps a very effective stick when it comes to collections, and I think it might accelerate what had already begun, which is, and I know this is common to both banks and fintechs, that there's a 6-month moratorium on negative listing on credit reference bureaus. But I do believe that ultimately fintechs can do more good as members or contributors of information to credit reference bureaus than non-contributors. That's because a lot of people focus on the negative listing, but the vast majority of our customers have actually been positively listed, as in have had information regarding their payment history contributed through to CRBs. It's also a question around how are other lenders using this information? Do other formal lenders effectively go to CRBs and pull a full credit report on a customer, or are they just primarily focused on has this customer been listed? And if other lenders are just using one piece of information, then of course I can sort of see how others would come up with this perception that fintechs who are listing customers are really just a net negative in the system. But to summarize, I'd say that look, COVID-19 has reduced lending volumes, not only for fintechs but also across banks. Removing the ability of both banks and fintechs to negatively list customers with credit reference bureaus does increase the risk of more willful default, and so therefore I think it accelerated the contraction in credit that was being provided by fintechs. And it's definitely our hope that we'll be able to work together with the regulator to sort of form a path back to reporting, as I believe that we actually have more of a net positive impact in being able to contribute information as third-party providers.
Mamadou, what are your thoughts? Blacklisting, regulatory dynamic in the broadest sense at the moment?
Yeah, no, I think that in this situation, I think that 3 things become really, really essential. And this is with COVID or without COVID, because I think that the challenge of people defaulting and being blacklisted has been there. And I think that one of the things is really about information that is actually shared and accessible to all stakeholders in the lending system. That's, in my view, one thing that shows also collective, if you wish, or aggregated commitments. I think this, the second thing and related to that is really around consumer protection as well. So what are the caps and limits that all lenders jointly giving loans can go up to compared to the income or the revenue that the consumer has to actually really not go beyond what repayment capability should be. But third, I think that there is also a need for innovative approaches, not just blacklisting, but actually understanding that some of these consumers or borrowers actually may go through difficult moments. And what are the approaches actually to support them to be able to bounce back and to come back from some of these challenges? Because blacklisting is really taking them out of the economy or seriously hindering their capability to contribute. But maybe there is a need for really innovative approaches to not get them out, but helping them to come back. And I think that's what Shakila talked about, which is really about how do we look at the data more creatively, really in an enabling way. And I think that would be maybe some of my thoughts around this, yeah.
I think they're very valued insights, especially now. We're looking at a very tricky situation where the challenges that were already there are now compressed and exacerbated by the COVID situation. There's always been, to my mind, a dynamic, an ecosystem between responsible lenders and responsible borrowers. And particularly in low data environments, getting that client protection and client treatment is hand in glove with product design. And it can be very difficult. And so I sort of think, Ivan, your points are well made that you know, what can be done to you know, act as a guardrail when repayment behaviors maybe are not as you would wish them to be, while you're trying to provide access at the same time. At 4G Capital, we're doing an experiment with Social Performance Task Force, SPTF, to try to have a much clearer view of the overall financial well-being and health of the borrower, which in our case is just the micro enterprise. We don't enter the consumer finance space at all. But you know, we already know that small businesses will often be desperate for credit to grow. But at the same time, as some of our questioners are also mentioning, they will be multi-funded, and there will be lots of different loans, lots of different places, and they'll often be reluctant to expose the full level of the finances because they don't want to prejudice their access to a loan. And then things don't always go to plan. They struggle to repay that loan, so they may well take another loan to repay the first loan, and vice and on and on. And so financial inclusion suddenly turns into a risk of debt entrapment and client indebtedness. There are frameworks for lenders to try to observe to help this. We clearly champion the SPTF framework. That's very helpful. The SMART campaign is another thing which we think is very helpful. I'm fortunate to be on the steering group for that. And in the long term, it really makes a better business from your perspective, because when that client is healthier, and it may well mean a smaller loan for them or a not right now answer for them, nonetheless, they will survive to thrive and to be able to handle their finances and to use those productively. So I would commend all participants to just take a look at the SPTF and the SMART campaign and their ways of doing things, and pick up what they can from that. I guess moving on with the question sets on the discussion, which have been so well put together. How really can we prioritize existing customers and community business data to better allocate existing digital resources? It's quite a broad scoping question, but I suppose the question is one of prioritization. Who do we help first? Who do we help first right now? Shakila, what are your thoughts?
That's a tricky question, because I think everyone needs help now. But I'd like
It's an awful question, because it's the name of the game. It's triage. But triage is the name of the game right now. It's horrible. But
yeah, so it's almost betting on people's lives. So I would say critical for me would be maintaining jobs. So who has like what would be, if a business fails, if our digital lender, if a business fails, how many people go down with it? So I'd look at it from that sort of scenario. So how many people depend on this business for their livelihoods? Because then that has a much higher ripple effect. Not that the smaller businesses with 2 or 3 employees don't deserve capital, but look at it from that angle. And also I'd look at it from a historical point of view, just in terms of performance. How has that business been performing in the past? How solid are its fundamentals? And then looking at it from an industry point of view and looking at it from the future as well. So if you look, if you look at the business, if it's a trade business, what do they trade in? What's the probability that business will actually pick up post the pandemic? Because the reality on the ground now, and unfortunately so, is that some businesses may actually never recover. So we need to be pragmatic about that in just terms of analyzing and directing capital to businesses that have a huge workforce and have higher probabilities of recovery post the pandemic phase.
Ivan, who do you think comes first in the priority order?
You know, I think I would look at prioritization between, as a lender, customers you've never dealt with, who are approaching you for the first time now in the middle of a crisis, and customers who you have dealt with in the past. And I actually think, and I'd agree that it's better to prioritize existing customers and community business essentials to better allocate digital credit resources, because COVID is testing all our underwriting models, right? And so therefore there's increasing associated risks of lending to first-time customers. You know, and repeat customers can demonstrate one of the strongest repayment signals, which is, of course, repayment of their last loan. You know, we have gone ahead to not only sort of focus primarily on these repeat customers who we have known and worked with over 5 years, but also, as I mentioned earlier on, in launching this COVID Rebuild Fund, we also decided to earmark a specific portion of capital, specifically to critical providers of community business essentials. And because we believe that it's not only good business, these are businesses where there's demand, but also it's common sense as well, and for the wider good. So I'm definitely in favor of prioritizing existing customers in a time like this, versus trying to serve almost all and even new customers who are approaching us for the very first time.
Mamadou, what are your thoughts?
Yeah, no, I agree with that in terms of prioritization, as Ivan told. I think that different stakeholders in the chain actually need different types of help, but we all recognize that micro and small businesses actually today need desperately capital to maintain the level of operations, but also it's not only them, but the organizations that support them and the lenders that provide that capital to them. And again, also the other type of support for micro and small businesses, what I alluded to in the beginning, is how do you help them actually continue to do business, to increase their sales, to remain open, and during this phase. But we at Visa have chosen really to provide capital to the investment partners, but also to NGOs and other organizations that support micro and small businesses. That's why we came up with a commitment of $200 million over the next 5 years to sort of infuse in the beginning that rapid, low-cost capital that can reach actually the micro and small businesses through these support organizations, whether they are lenders or other types of service providers, to ensure that actually they are being able to remain in business and reduce actually the death rate or the fallback rate due to the impacts of the crisis. The second thing is also looking at what type of investment through that also we can do, provide to help that recovery phase and that growth phase. So for me, it's just different types of services for different types of actors in the chain. But again, for obvious reasons, focusing mostly on existing partners and customers also makes sense due to just difficulty of due diligence and all what is needed to onboard new partners, new customers as well. Yeah, so that's for to cater for rapidity and effectiveness of the response that we are bringing.
I think really all three of you have done a great job of just laying out the contours of this horrible time where I think it's Jack Ma has said just focus on surviving 2020, never mind growth rates or crazy multiples or anything like that, just survive and get through it. And that of necessity means that a lot of potentially very viable businesses that are not within the gateways already of relationships with lenders are going to struggle. I think maybe that's a conversation from a different forum, but I'd just like to raise it up that you know, for people, governments, regulators, anybody else who might be on and listening, let's just make sure that our awareness is going beyond our own client bases, even if we're not, as lenders ourselves, in a position to help those people. Another question from the attendees, this time from Ethiopia, from Tedros Halle. Apologies if I haven't pronounced that correctly. Really asking what are the main strokes for taking a bank to transition to digitization, where transactions now really need to be touchless, where cash and physicality is something we want to reduce. How can we see the fundamental foundations of digitization be applied? Shakila, you've got a great oversight. I want to go through all of you again because you all bring us something very special to the party on this, having seen transitions from analog to digital, or indeed being practitioners in your own right. So Shakila, what are your thoughts? How can we help banks to make this move?
So I think just traditionally, the digitization journey for banks is quite capital intensive. So it's also looking at, do they have funds available to do that? Because there's a lot of technology and infrastructure changes required. And of course, definitely staff training. And given the social distancing requirements in most countries, then also how will you ensure that all your staff is up to speed, and that's throughout the country. So it's definitely going to pose challenges, but it's not that it's undoable. So luckily, there are actually very many vendors. So the digital world within the banking spectrum is quite broad nowadays. So in terms of vendors and in terms of which vendor is most appropriate, because I think the issue and what most people struggle with is acquiring the right technology. So that's as a nonsense. So after the capital, so yeah, struggling with getting the actual capital to invest. After the capital investment is, are we actually getting the most suited technology for our type of business? And I think luckily now, just like payment providers, so the digital vendors are actually sort of experiencing an upside in their business. And luckily, there is scope to learn from other countries. So you could learn, if it's Ethiopia, you could learn from your neighboring countries. You could learn from Kenya, you could learn from Uganda, you could learn from Tanzania. So you don't have to do everything from scratch. And there are consultants who can actually sort of provide that sort of expertise digitally, just to ensure that you get the right software and the right technology and infrastructure to set you up digitally. Then the next question would be, then once you have that, how do you train your staff? Again, also, given that the world is moving digitally and with digital e-learning resources, the scope, it may not be perfect, but the scope to also bring up to speed at least your core staff, your IT department, and your core client-facing staff on how to interact with this. Then the next challenge would be once you launch. So how do your clients interact with that? I foresee a bit of challenges, but then again, as I say, given that the world is going digital, so everyone is quite open to the digital spectrum, and the fact that people are limited and can't actually physically go to the banking hall or go to an agent to transact, then hopefully people will be incentivized and open to accept a new mode of transaction.
Kevin, what's your advice to a bank to capture the magic of fintech?
I think there's the danger sometimes of putting the cart before the horse, right? In terms of before a bank can think about how can we go digital, you really need to look at your client base and the economy around you. So I think there are a number of enabling factors or foundational requirements which would really enable a much faster transition to digital. So I look at things like, to what extent are your customers already using the digital platforms that you want to start offering services on? What is the rate of internet connectivity, the costs associated with that? Are your customers more mobile versus web? And to what extent do you actually have payment rails like mobile money in place, right? Because I think the danger, not to contradict Shakila, but the danger sometimes in looking at, say, what Kenya has done and what Uganda has done, there are some foundational advantages that these countries have had, and primarily mostly around mobile money. Or they sort of become very mobile first. Maybe there's enough competition in the sort of telecom space where you actually have access to affordable mobile internet. But fundamentally speaking, though, I do think that given the need to socially distance, perhaps this is one of the silver linings in this crisis is that you will perhaps see interest and a drive across many parts of economies to go digital, which will then enable a bank to sort of ride on the same. But I'd really caution any bank sort of trying to put the cart ahead of the horse and sort of launch a fantastic digital platform that has nothing to do with the capability of their customer set. Sorry, not to be too bearish, but
No, it's very interesting. No, never apologize. Mamadou, what are your thoughts? You must have seen this a number of times around the world.
No, I think that when you look at digitization again, I think that there are things that which are the low-hanging fruits, what can be done now immediately. But there is also that bigger sort of vision around really building digital. And I think that is not just, if you go to the big one, it's not just the banks, but it is really a sort of bigger ambition that brings also government and others. Because if you think really about the issues of infrastructure, I think Ivan alluded to them, connectivity and all of that. That's one thing that banks cannot do alone. And I think that they need also support from government and also other development partners. But then you think about all the softer skills that, or the softer parts that allow actually to interact and use that infrastructure. Some to speak to also consumers and micro and small businesses as well. And that is a lot of training, a lot of reaching out, which I think that takes a long, it's a long-term effort. But however, I think that right now there are many innovative and low cost and affordable approaches that can help digitize some of the segments that today are still excluded. When we think about the millions of merchants and micro businesses in the markets and others, they don't need to have a POS machines, devices, and others actually to join the digitization. Through QR codes and soft POS and low-income POS, there are a lot of small technologies actually that can be deployed today at lower cost. And I think that it's really the effort of reaching out. And I think that the benefit from that is it's really also building new frontiers for the banks and lenders, opening up new opportunities. Because unlike, as we all know, unlike cash, digital payment is also data. And we know actually data is critical for these institutions to think, analyze, do the necessary analysis and think about longer term strategy and that actually is commensurate with their overall corporate view in terms of transition over time to digitization. For me, small, low-hanging fruits first, inclusion, bringing through low cost, but thinking also about a bigger approach, multi-stakeholder approach, I think, for a longer term transition. And looking at also other use, not just payment, right? And this is where
absolutely. Yeah, absolutely. Just, I mean, Mamadou, we began with quite an interesting description of, what Visa was doing immediately to try to address the COVID impact. Could you just expand on that a little bit more, and then tell us what's the focus of social impact at Visa?
Okay, social impact at Visa is just to help what further the mission of helping individuals, businesses, and economies connect through a reliable platform, secure. But also, how do you leverage that core business to actually be a force for good and contribute to inclusive economic growth? And this is why we have chosen really to focus on micro and small businesses, because of their role in the economies in the emerging markets. We all know the data, that in emerging markets, those micro and small businesses are about 80 to 90% of all businesses, and they contribute more than half of GDP. And provide actually more than almost 2/3 of all new jobs in a given market. Then if you're talking about economic growth, if you're talking about inclusive economic growth, it does make sense to focus on those. And what we're bringing really from a social impact perspective is really how do we build and enable actually access to different types of services, some being around skills and knowledge, others being around access to different types of finances, whether it is credit, it is insurance, it is other types of financial services, but all of this enabled by actually digital payment and affordable and appropriate digital payment. So that's what we are focusing on, and we are always looking at how we can leverage the assets and the solutions that we have in any given circumstances to help that kind of inclusion. Some of the examples I shared earlier around how do you waive fees for the new those starting businesses. How do you enable through digital increased business? How do you also remove certain barriers to access to digital? So that's what we are focusing on.
Fantastic, that's great. Ivan, how do you see fintech in East Africa particularly changing in a post-COVID world? Are we going to go back to how things were, or are we in a different uncharted landscape?
Yeah, so that's a great question. There are many trends and that will influence how fintech looks like in a post-COVID world. I think for one, we're all going to have to really re-update our underwriting models, right? In many ways, the signals that we relied on to determine who is safe to lend to need to be reevaluated, not necessarily thrown away, but we definitely need to start thinking about what are the new signals that we should incorporate into our underwriting models. That is one. So those who fail to do that, I think will continue to see some very high default rates, right? A second thing is that, especially in East Africa, we are seeing a very strong march towards regulation, which had actually began before COVID. But I know that, for example, as seen by the CRB regulation change, I think the regulator still expects to continue with that timeline. So I think that if you're a fintech, especially a lending fintech in East Africa, you should already be doing the work right now to not only bulletproof your business against any hemorrhaging that you're having right now, but also get ready for potentially increased capital requirements and a whole host of other new restrictions that could be put in place once we are regulated. I also think that there will potentially be consolidation in this space, because not every fintech startup will have the capital, will have the internal know-how on how to update the underwriting models. And so you may see a couple of startups, worst case, unfortunately, either die off, merge, or acquire. So I'd expect to sort of see a lot of that activity over the next 12 to 18 months. But ultimately, those that do survive, who get through COVID, will ultimately be much stronger and regulated entities, and will probably look a lot more like neobanks than sort of standalone entities that we have today. So it is going to be a very exciting time to sort of see what happens in East Africa, but definitely the trends around increased defaults unless you update your models, increased regulation, and consolidation are definitely three of the key trends that I expect to see in a post-COVID world.
Shakila, what are your thoughts on the world post-COVID, and particularly the role of data and analytics? There's a huge amount of data out there, and that's being employed to greater or lesser degrees by people. How do you think this opportunity really manifests?
So as Mamadou has mentioned, I think as we go digital, then data becomes key. And I think just traditionally, SMEs have not been able to access credit primarily from banks due to information asymmetry. So banks do not know what type of institutions they are, because they typically have informal or incomplete records. So they have no visibility on the transaction history. They don't even understand the nature of business, because then SMEs and micro enterprises operate in a myriad of different types of industries and different types of activities that banks, just given the way they operate and the way they are structured, can't invest manpower to sort of analyze and understand these businesses and appropriately credit analyze them for risk. So the beauty about data and the beauty about going digital, which unfortunately comes with risk, but the benefit is that it has this, it creates a lot of data footprints. And as Ivan has mentioned, be critical then going forward as we go into the recovery phase post the COVID pandemic, is how are we analyzing this data? How are we utilizing it to effectively understand our customers better, understands the risks that they face in a business, understand how we can help them as a financial service providers, and then ultimately understand how we can price loans to them in a way that is actually beneficial to them, doesn't cripple them, and that also makes business case for us. So I think that's the role that data will play, and it'll be very critical in improving the algorithms, as Ivan has mentioned, because it gives you foresight, it gives you past history, and it's not only transactional data. So there's you can have behavioral data. There's a lot of different data points that can actually be incorporated in this algorithm to be able to appropriately analyze risk and price credit, so that then we can increase access to more SMEs and to more micro businesses.
And just as regulation came up, and I mentioned it, and one of our questioners mentioned it, and Ivan has spoken on it, I think quite wisely. What's your thought of the opportunities for regulators as well as the challenges of compliance?
So I think we're actually in an opportune time in history because there's been a lot of talk about regulating digital credit providers, and this is primarily linked to consumer perception. So you mentioned the smart campaign. So some credit providers actually subscribe to the smart campaign principles, but there needs to be some sort of enforcement. And this is just the opportune time for regulators to come in, to sit down with industry, with suppliers, to actually try to see how regulation can be enforced in a way that doesn't stifle their businesses, but also protects consumers. So there's a lot of talk about data privacy and protection. There's a lot of talk about cybersecurity and fraud. So even as we talk about data, how are we ensuring that we're not inappropriately using consumer data? How do we ensure that we get their consent to use their data? So it's not enough that you have access to my data. I have to consent for you to actually use it to give me credit. And the thing with data also, I know when we talk about data, people often mention the sharing aspect, so that like your telco will share your data with whoever without getting your consent. But another important thing is also what data is being used for your algorithm. Do you know what data someone is using to score you or to give you credit only for 1 month as opposed to 2 or 3 months? So it's some of these issues. I think this is the right time for the regulator and industry to sit down and come up with solutions that actually protect consumers. And there's the issue about unfair collection practices. So there's scope there as well to now streamline that, to make sure that everyone is in agreement. And I think most importantly, the mechanisms for dispute resolution, because the thing with digital as opposed to conventional product, so there's no touch point where a client can, walk into a branch, issue a complaint or whatnot. So it's time that we actually address this lapses or critical gaps within digital credit business models that have led to unfair treatment of consumers. So the time is now. There's no better time. Yeah.
I could not agree with you more, and it's really good to hear the voice of digital data sovereignty and client data protection really come up in such a rich way. I think that nobody now is comfortable with the way that their own personal data is being used, whether it's for targeted ads necessarily, or whether you just don't know where it's going and what's happening. We are in an area where data unlocks opportunities. And if we're talking about financial inclusion, we're talking about enormous amounts of risk on the part of lenders. And those lenders are to be commended for leaning in to try to provide that financial inclusion. But there are ways of going about it. And I think the market conduct points speak very, very strongly. In fact, we've got a question right here, I think from Kevin again, saying how can we humanize collection behaviors? And I think you probably answered that question already by adherence to things like the SMART campaign, things like SPTF and other client protection protocols. And in our experience, I have to say this really to all my friends and colleagues in the industry, being, the more respectful you are of your clients, the better your repayment rates tend to be. We average 94% collection rates on time as a rule. We don't report people to CRB. We don't do data scraping. We don't do anything remotely unsavory, because it just doesn't work. Aside from being the wrong thing to do, it just doesn't work, because when people are vulnerable and people don't have much, all they have is their dignity. All they have is their pride. And when they've got a loan, that's threatened. And so I think you mess with that at your peril, and at the end of the day, your default rates will be high and your reputation will suffer. So again, another shout out for things like SMART and the frameworks. And there's a lot of thought leadership out there. FSD Kenya, FSD Africa, other think tanks and catalytic vehicles are there to provide encouragement to enterprises who don't necessarily have a fully spun up client success cell or a depth of capacity to be able to try to do these things. Much like the answers on the digitization front, you don't have to come up with it all yourself. Right, we're very close to time, my friends. We've got about 2 minutes left, and there's a very, very human question that's just come up. How do you stay well, and how do you keep it together when you're working from home, isolated, far from colleagues and the usual stimuli? So I'll give you a rest to master your thoughts, Shakila, whilst I harass Ivan now. How do you keep looking so good in this time of crisis, Ivan?
Wow, I didn't expect that question. I thought it was all financial inclusion and SME lending. I think a large part has been about creating routine and custom, even in your home environment that resembles the work environment, right? So it's I say simple things like waking up at the same time, getting dressed to go nowhere, having a fixed place of work, having strict timelines that only protect your home life from your work life. So making sure that anything those around you know when you're on and when you're off, and having the discipline as well for you to also go ahead with that. Squeezing in a home-based workout if you can, and staying away from the fridge. I think that's pretty much all the practical advice I have.
That's fantastic. Mamadou, what are your secrets?
Yeah, no, but if you allow me, Wayne, before I say that, I wanted to come back to that question about how to humanize collection methods and stuff. I think I would argue that actually good collection starts with good credit. And all of that is done before you put the credit. How do you understand the needs of your borrowers? How do you become more flexible and agile, not have just standard sort of offerings which actually ignore, the specific needs of clientele? How do you tailor that? Myself, using in my mobile, I used to receive a lot of offers of loans that do not need match my needs. So that means those sending it to me don't even know me. So how do we know to meet immediate needs and future goals? I think that's where it starts to have really a more human relation. Having said that, I think that it is, for me, one thing that has really been important is actually better balancing now work and family life. In my role, I used to travel a lot and be always away from family. Now I'm more closer to family and also doing a lot of exercise. Exercising as well has been also one way to help me actually keep sane. Yes.
Fantastic, fantastic. And Shakila, what are your secrets to success? How are you keeping it together?
So I don't have much to add. So same thing that Ivan and Mamadou have said. So sticking to a schedule, waking up, showering, dressing up, sitting at my workstation, and also just that dedication, whether it's between 9 or 6 or 8 and 5, like this is mommy's time, mommy's at work, and my son will say, oh, you're working. So just being quite clear that you have your productive hours, but then also the important thing is switching off, because the risk of working at home is that you could just keep working endlessly. So just having that switch off button and making sure to rest over the weekend and having 1 hour of exercise each day. I think that has helped me to keep sane, definitely.
Yeah, fantastic. Those are wise words to us all. Well, I'd love to thank my co-panelists. Thank you very much for bringing your insights, your expertise, your experience, and your fantastic contributions to this. Julia, I don't know if there's any other wrapping up you want to do. It looks like we're at time and we haven't had too many people drop off. So I hope to all of our viewers and listeners that this has been helpful for you. And please do keep staying strong, looking after one another, looking after your people. And we look very much forward to seeing you at the next time.
Thanks, Wayne, and thanks to all of our panelists as well for joining today. I hope you all enjoyed that session. So that is the end of the webinar. Again, thank you all so much for joining and to our audience as well. The webinar will be accessible via our website for on-demand viewing. And if you do have any questions, please feel free to reach out to us. We'll be running our next webinar on Tuesday, the 9th of June, and we'll explore uncovering AI opportunity in the BFSI sectors. So thanks again to everyone for joining and for listening, and we hope to see you again soon.
Fantastic. Thank you.
Thank you.
Bye.
Thank you. Bye.